Hello, my name is Amit Trivedi, and we are going to discuss some of the external influences on personal finance. Now, these are factors that can influence the financial situation of an individual or a family, but these are factors which are, as the title suggests, external to the individual's situation or the family situation. Let's take a quick look at these factors. So, we are going to look at 5 external influencers, 5 external factors. Number 1, something that is totally unexpected and that can also happen. Similarly, there is the broader economy of the country, and the structure of that economy may have some influences, and from that point of view, it's important to understand the Indian economy. Businesses and economy both go through various cycles of growth, downfall, growth again, downfall again, and these cycles also impact the economy and one's financial situation. Of course, taxes play a major role. The tax on one's income, tax that one can save through various instruments, these taxes play a role. And finally, we'll look at a major development that has taken place in last few years, couple of decades actually, in the way the pension reforms have taken place in India. Let's jump into the first one, which is expecting the unexpected. And very often we are not prepared because it is unexpected. What is not expected can happen, and that's why economics comes up with some amazing theories. And these theories, the first one is called the chaos theory. The chaos theory broadly explains what can be an influence to someone's situation. As you can see here, there is a butterfly here, and this effect is also called the butterfly effect. It may sound very, very weird, but let me just first explain what this butterfly effect means and then take a recent example, real life example. This butterfly effect says that if a butterfly flaps its wings somewhere in, let's say, South American continent somewhere, that can cause a storm in a country as distant as Bangladesh. A butterfly flapping its wings in another part of the country could be the cause of a storm in a distant country. Now that sounds weird, but it has to happen at a particular point in time. Now, this effect can be only understood if we look at the entire universe, entire world as connected. And especially in financial markets, especially in economics, so many things are so well connected. First of all, a very recent example of COVID-19 pandemic. Apparently, there was one virus that started multiplying in some place, in some part of the world. What happened subsequent to that can be an equivalent of a butterfly effect. Go back a few years. In the year 2008-9, the world faced what is popularly called the global financial crisis. And this global financial crisis meant that financial markets the world over suffered. Now look at a situation where, because the financial markets suffered across the globe, an investor in the Indian stocks, Indian mutual funds, saw decline in the portfolio value. What was the origin of this global financial crisis? The origin can be linked to the default in housing loans in some parts of United States. Classical butterfly effect kind of a situation. Some people in the United States could not service their home loans, and the portfolios of Indian investors lost value. Now, this butterfly effect talks about seemingly unconnected things influencing one another. But there is another way to look at the unexpected. And for that, there is a concept popularly called the black swan. Now, what is this concept about? For ages, all the swans that we had seen were white in color. Somebody can deduce from that there are only white swans, and that also means a swan cannot exist in black color. However, for centuries, something that was not known very recently, a few decades back, a black swan was spotted somewhere in Australia. The economist used this example and said, till then, just because we had not seen a black swan, we assumed that there is no black swan. But one existed. What we have not seen so far may still exist. Now, that exactly happens in economic events. Something that has not happened so far, we tend to believe that it can't happen. But then again, it does happen. And this black swan event is something where most of the times, actually, not really in all cases, but most of the times the black swan event is all about a major crisis or a major market crash, a major economy going into recession. Generally, this black swan term is associated with negative but extremely, extremely rare events. Because these events are rare, because nobody has heard about it, read about it, or obviously not even experienced it, people tend to be unaware and unprepared for these kind of events, which are the unexpected events. Think of a stock market crash of more than 10% in a day. Extremely difficult to imagine, but then again, can it happen? Well, so far that has happened a couple of times in India. Now extend that further. So far, that is the 40 odd years history of Indian stock markets. I'm only talking about that history as since the date of inception of Sensex. The markets existed even before that. But in these last 40 odd years, we have not seen the stock markets crashing by 20% in a day. Does it mean it can't happen? Well, I'm not predicting anything, but what this concept of black swan says is that we got to be prepared for this kind of outcome also. That's the first part. The second influencer is the structure of the Indian economy. Frankly, it applies to economies across the globe, but we will talk about it in the context of Indian economy. There are two broad influences. One is what we call the monetary policy, and second is the fiscal policy. These are policies are also known as strategies. The first one, which is monetary policy, is administered by the monetary authority of the country, and this role of monetary authority is played by the Reserve Bank of India in our country. So monetary policy is managed by Reserve Bank. The fiscal policy and fisc is the financial situation of the country, and to that extent it happens at a much bigger level. It is all about the expenses and income of the government. These are often referred to as the sister strategies because they do influence each other. They play a role, and the government and the RBI often work together with a common objective. And we'll see what could happen in each of these policies. When they are used in various combinations, they can impact the various economic goals that the country has. And what are these broad economic goals? Typically, the broad economic goals of the country are the growth of the economy, by keeping the inflation under control, and at the same time ensuring that the foreign exchange rates also move smoothly and do not go out of the hand. Now, when you look at all the three together, it's not an easy task, and that's where the government and RBI will have to keep intervening at various points in time. Let's look at those interventions by taking a deeper look at both these policies. As we just discussed, the monetary policy is implemented by the Reserve Bank of India. This policy impacts two things: the supply of money in the economy, how much money would be available, how much money may be withdrawn from circulation. So one is that. The second part of the monetary policy deals with the cost of borrowing. If I don't have enough money as a business, I can always go to a bank and take a loan. Now, if this loan is available at cheaper rates, I may be able to borrow more to run my business. If the interest rates on these loans or the cost of borrowing goes up, then my ability to borrow may get impacted. My ability to borrow reduces. That means I have less amount of money available to run my business. So that's the second part of it, which is the cost of borrowing or interest rates. And that's why the other name for monetary policy is monetary and credit policy. As we just said, it deals with two things: supply of money and the cost of borrowing. The objectives of this policy are, number one, stability of prices of various goods, commodities, products, etc., which is nothing but, and some of you might be familiar with this term, inflation. When the prices rise, that rise in price is called inflation. So first objective is to keep inflation under check. The second objective is to fuel economic growth by making enough money available at a reasonable cost. Right? So by managing the supply of money and the cost of borrowing, these two objectives can be achieved. However, if money is easily available, companies can deploy that money If the money is available at a lower cost, which is lower interest rate, companies can borrow more and use it for productive purposes. When money is easily available at reasonable interest rates, the consumers like us also can go out and borrow money, buy houses through home loans, buy vehicles by taking vehicle loans, buy consumer goods by taking those buy now pay later kind of schemes. And when that happens, the economy grows fast. But please remember, because people have started buying more, the demand supply equation says the demand for something goes up, the price is likely to move up. So while the growth is fueled through availability of money, the same availability of money and the same growth may lead to rise in inflation. And that's why it's very important that the monetary policy is used by RBI judiciously to ensure that we can achieve growth by keeping the inflation under check. So the objectives are a little conflicting with each other. As we already mentioned, the supply of money is something that RBI can control, and there are various means of doing that. They can also change the structure of interest rates, and the structure of interest rates also can be seen not just as the cost of interest or cost of borrowing. It is also about if you are borrowing for short term versus if you are borrowing for long term. The interest rate for a 1-year deposit in a bank versus a 5-year deposit in a bank, there is always going to be a difference. The long term deposits are yielding more interest or giving you more returns. Now this gap between short term rates and long term rates can also play a big role, and RBI can influence that gap as well. So that's why the line that we mentioned out here is not just the level but also the structure of interest rates in the economy. There are various other credits that RBI may impose. Take for example, they may direct the banks to offer loans to certain sections of the society or the economy, or they may direct the banks through various controls to reduce the availability of credit to certain segments of the society. Which are these segments? Let's say if you want to borrow money to trade in the stock market, which is often a high risk speculative strategy, RBI may not want people to use credit for such purposes, and to that extent they may direct banks to keep a certain limit on how much loans can be given for stock market related activities to individuals like us. Sometimes they may also look at certain other segments of society, and if they see the practice is going a little faster than expected and the quality of loans is not looking healthy, RBI may want to cut down exposure there. But at the same time, let's say sometimes to fuel growth in the rural India, they may encourage policies where the banks are rewarded for extending rural loans. So these are various mechanisms that can be used. The sister policy to monetary policy, as we just saw, is the fiscal policy. This policy is actually about the level of spending of the government in connection to the money that the government is likely to receive. And this fiscal policy can play a huge role growth targets for the economy. Now, in order to understand the growth of the economy, first let's take a look at how we measure the economy's size. And the size of the economy is measured through a factor known as gross domestic product, popularly known as GDP in short. Now, how do the economists calculate the GDP of a country? And here is the equation. Now, this equation is very important to understand. First of all, the C says consumption, and this consumption is by households, people like us. How much goods and services we consume contributes to the GDP. The second is the I, and this I is all about investments in capital goods. Who does that? The private sector, the businesses, the industries. Third, the G, and this G is the government expenditure. The final term is mentioned in a bracket called X minus M, where X is the imports by Indian manufacturers, Indian service providers, and because of that export, we earn forex revenue or whatever revenue from outside the country. At the same time, M means import. So, X minus M, while in C, I and G the first letter of consumption, investment and government are taken, in case of export and import the second letter is taken, the X and the M. When you import something, the goods comes from outside, whereas the money goes outside of the country. And why is it important? Because what the consumers consume and the amount of investment in that the industry has made, if that goes towards import, there is a negative impact on the GDP. The size of the GDP goes down, or the C and I, those things get cancelled by the M. It applies to government expenditure as well. Take for example, India has been a major importer of petroleum products, crude oil. India also has been a major importer of gold. Now, when we consume petrol, it gets counted in the GDP through this C, but it gets nullified through this M of import. Now, why is it important to understand this particular equation? It is critically important because now you look at the overall equation and the impact that it has on people of India. First of all, when the size of GDP this year is higher than the size of GDP last year, that means the GDP has grown, the economy has grown. And when the economy grows, that means the aggregate demand and supply within the economy has gone up. The businesses are investing more, consumers are consuming more, and due to that, the unemployment rates go down. Inflation may go up, consumer spending goes up, and these things can also have a bearing on the profits of the companies. So, overall, when the economy grows, people become wealthier, the companies become more profitable, and that augurs well for everybody. But for some reason, and we just covered the black swan event or the butterfly effect some time back, for some external reason, if the Indian companies do not feel that the future is good, they are likely to reduce their investments. When the consumers feel threatened, and this threatened about loss of job, reduction in income, and in such cases they may start saving money rather than consuming money. Now, saving per se is not bad, but some basic amount of consumption is also essential for the growth of the economy. So when people don't consume, industry does not invest, then how does the economy grow? And that's precisely where the government must step in. And the way the government can step in is by increasing their expenditure. And when government starts spending, there is automatically some demand. And when that demand takes place, the industry may look at a brighter future and again start investing. When the industry looks at a brighter future, the employment also goes up. When employment goes up, the wages in hands of people, the money in the hands of people go up. And when that cash flow comes, the consumption is also likely to go up. Overall, the government can influence revival of the economy through increased spending. Okay? This is just one of the perspectives. There could be other repercussions as well. For example, when government starts spending, and we'll look at government finances sometime later, when government starts spending, inflation may also go up. And that inflation sometimes beyond a point can hurt the economy overall. Sometimes the government may also need to decrease the spending when the consumers are consuming, the industry is investing. Because of that, the economy is growing at a very fast pace, and due to which there is a fear that inflation may go out of control. The other way the government can influence the growth of GDP is by changing certain policies. And this is where fiscal policy comes in once again. They may incentivize the industry in a manner that they invest more amount of money. They may give certain advantages or benefits due to which consumers may start spending more. Take for example, if you take a home loan, there are two tax benefits available. When you repay the home loan, the interest component that is paid within the EMI is available for some tax deduction. The principal repayment within the EMI is also eligible for some tax deduction. So if you are taking home loan to buy your own house, there is a potential tax benefit. Now, this is one of the tax policies that the government has. Similarly, in order to develop certain areas, government may allow industries to set up their plants and factories or their offices, and for a certain period, those who have invested in that area, they get certain tax holiday, which means for a few years, these companies may not have to pay any tax, while generating employment for the people around that factory or plant or the offices. Government policies do influence GDP growth overall that way. So while we talked about two of the external influencers, let's look at the third one, which is where we'll discuss about the business cycle. And the business cycle typically can be seen through this graph. The diagram actually shows a very smooth wave, but the real business cycles are anything but a smooth wave. There are ups and downs even along the way. However, the broader structure of the business cycle may look similar to this wave. And what is that? While there is a long-term growth trajectory, as you can see through this green line, the actual movement is around that green line. Sometimes it goes far up, then it comes down. So while this green line looks like growing, the yellow line is falling here. The business cycle is believed to have 4 different phases or periods. This particular period, where you are moving from the bottom to the top, that's called the period of expansion, or it is also called recovery. The most common word used for that phase is the growth phase. The opposite of growth is called a contraction or a recession, when you are moving from a peak to bottom. So while these moves from top to bottom and bottom to top are 2 periods or 2 phases, the other 2 phases are the peak itself and the trough, or the highest point and the lowest point. Let's look at each of these 4 phases separately. First, look at the growth phase. Now, this growth phase that we talked about is this part. And as we said, there are multiple names for that. It's also called expansion because the economy is growing or expanding. It is also called a recovery phase because you're moving from a bottom to a top. And the bottom is reached through a contraction. So after contraction, the phase that comes, that's why it's called recovery also. Growth, expansion, recovery, different names for this particular phase. It moves from a trough to the peak because the GDP is expanding. New employment is generated. The business activity surges. New investments are made by the industry. Overall production in the industry, overall income of the companies and the individuals, the profits of the companies, all these things expand, all these things grow. And overall, this is a phase where it is said that the economic climate is good. So this is that happy phase of the business cycle. Now this happy phase reaches the pinnacle of happiness, and which is where you reach the peak. This is the highest point in the economic cycle, where the growth is at the highest level in the recent few years, where the profits of the companies look like they are towards, if not all-time high, but at least the recent period highs. However, because we are at the peak, of course, whether we are at the peak or not will be known only later, not when we are at the peak. The spending also tends to be at its highest potential. The capacity in the businesses also tends to be fully utilized. But then after that, the demon of inflation would have raised its ugly head. The characteristics of peak, once again, are when the business activity appears to be at the highest level, the capacity utilization may appear to be at a highest level, but at the same time, the inflation also would be reasonably high. And after peak comes the fall. Now this fall, or the contraction period that we see, where it is contraction, which means the economy is likely to start shrinking in size. And that shrinkage typically takes place when industry may not have a bright view of the future, and in that case they may reduce further investment or delay further investments. Consumers may delay spending, and especially on the luxury items, especially through borrowed money. And in such case, when the GDP growth does not grow or contracts, you see this particular phase, it may lead to negative growth of GDP. What it means is, when the GDP was at a particular level in a year, the next year the size of the GDP is smaller. When this negative GDP growth continues for 2 quarters or longer, then it is called a recession. So please remember, recession means 2 consecutive calendar quarters of negative GDP growth. Now, it has to be a calendar quarter. January, February, March is a calendar quarter. April, May, June is another calendar quarter. So you look at these calendar quarters. Second, there has to be a negative growth or the contraction or size of the economy going down for a quarter. And number 3, it should happen for 2 consecutive quarters, which roughly means the economy has shrunk for a period of 6 months, half of a year, and that period is called a recession. In this case, income may go down, even employment may go down, people may lose jobs, companies may not add new jobs, and overall, the mood may be somber. What happens in such cases, because government may do whatever, but if the consumers and industry, if they are not using credit, they are not borrowing, in that case the demand for borrowing goes down, which leads to fall in interest rates. And when the interest rates fall, the sign is that now we are approaching closer to the end of this decline, and that closer to the end of the decline means we are almost approaching what we call the trough or bottom. This is the period that we are referring to. As we mentioned, in case of a peak, the trough is known only when the recovery starts and not before that. When you are at the bottom, you don't know whether you are at the bottom or not. Take for example, in this incomplete diagram, and by design it is kept incomplete. At this particular point, it's extremely difficult to know whether you hit the bottom or the bottom is still some way ahead. What happens in this case is, as we just mentioned in the discussion on contraction, the interest rates would have fallen. And the interest rates and inflation also have a very close link. So inflation would also be on a lower side. Please remember, when people are not consuming, people are not buying, the supply of goods may be there, but the demand is less. Obviously, in such a case, the inflation is likely to come down. The trough is also called the phase between contraction and expansion, because from trough, from the bottom, the next phase is going to be recovery again. Recovery's other name is expansion. The output from the industry or the employment requirement from the industry is likely to be at the lowest in recent years. And then the revival starts. Why is it important to understand these business cycles? Because where the country is in a business cycle, where the economy is, where various companies are, would have an influence on the lives of people. Expecting the unexpected, the monetary and fiscal policies, and the business cycle are three topics that we just discussed. The fourth topic, and something that really hits us hard, is the personal taxes. The taxes that we pay out of our income, out of the profits. Somebody has beautifully said that there are only two certainties in life: death and taxes. And somebody added to that line, said, yeah, that's true, these two are realities, but we don't have to die every year, hinting that we have to pay taxes every year. So the dislike for taxes is such, and if that's the case, why do we need to worry about taxes at all? Well, we'll see that as well. First of all, what is taxed? And that's where the major heads of the income must be understood. If you are working in a company as an employee, if you are working in army, if you are working in government office, if you are a school teacher, what you earn from your employer is called a salary. So salary is subject to income tax. Along with salary, if you are eligible for some bonus, bonus is also added to the salary income and taxed at similar tax rate. But when you retire from the job and when you are receiving pension from the employer, that pension is also treated in exactly the same way as salary for the purpose of taxation. During the job, while you are working, you may get certain perquisites. What are these perquisites? These perquisites could be certain expenses that the employer takes care of, certain loans which are given at cheaper rates by the employer. Some of these perquisites are also subject to tax. But if you are not in a job and you are working as a doctor, an architect, a chartered accountant, practicing in that manner, what you earn from your clients, patients, etc. is called professional fee. This professional fee is also taxable. If you are none of these, and if you have invested money, or if you are one of these, salaried, retired, professional, whatever, and you also have invested money, you earn investment income. And all these investment incomes are subject to taxation. Broadly, things like fixed deposits, debentures, bonds, you earn interest. There is certain way these things are taxed. If you invest in a real estate property and given it on rent, the rental income is subject to tax. If you invested in equity shares, mutual funds, if you have any dividends, there is a tax incidence. Or you sell the debentures, bonds, shares in secondary market, mutual funds when you redeem. If the sale price is higher than the purchase price, the profit that you earn is called capital gains for the purpose of taxation, and that capital gains is subject to tax. Finally, there are certain clubbing provisions. What does it mean? If I am an earning member and my minor son is not an earning member, if I have invested in my son's name, the income generated out of the investments made under the son's name, who is a minor, would get clubbed into my income. So there are various provisions. Of course, this is a detailed subject, and clubbing itself is a very, very detailed subject. But income gets clubbed in certain situations. and would be taxed at the entity who happens to be at the highest tax level. But at the same time, not all income is subject to tax. There are certain categories of income which are called exempt income, exempt from taxation. For example, one of the popular investment avenues is Public Provident Fund or PPF. The employers also have to deduct some amount under the Employee Provident Fund scheme. When these investments are done, whether it is Employees Provident Fund or the Public Provident Fund, the interest income on these is exempt from tax. Government of India has come up with a scheme called sovereign gold bonds. There also the interest payable annually on those bonds is tax exempt. There is something called standard deduction available to all taxpayers. For a certain base amount, the income is exempt from any tax. Income beyond that limit starts to attract tax. Now, it is applicable for salaried people, it is also applicable for professionals. In case of an investment, we just saw that the capital gains that you earn are subject to tax. Now, what about capital losses then? So, let us say I bought share of company ABC, and that share I sold at a higher price, which means I earned some capital gains. Assume that the capital gains I earned was 100 rupees. On the other hand, I had bought shares of company XYZ, and when I sold that share, the price was lower than the purchase price, which means I incurred a loss. So, here was a capital gain in the share of company ABC, and here was a capital loss in case of share of company XYZ. Now, assume that the loss in case of company XYZ was 40 rupees. So, in case of ABC, I made a profit of 100, in XYZ, I lost 40 rupees. These 40 rupees can be set off against the capital gain in case of ABC, and which means now I will be required to pay tax on net capital gains of 100 minus 40, which is 60 rupees. So, this set of provision is also available. We took an example of share capital gains, but there are various other provisions where such set-offs are available. There are also certain provisions where set-offs are not permitted. Right? So, one needs to go into detail of that. In order to encourage responsible financial behavior, the government also works out certain policies. You remember under the fiscal policy, we did discuss that the government may incentivize or make certain policies to encourage or discourage certain activity. While that was in the context of GDP growth, there could be other provisions that the government may use to nudge people towards something else. And this is where some sections of Income Tax Act are very important to understand and know. Under section 80C, there is a certain limit available. There are certain eligible instruments available. So, if you use your money for those things, then your tax liability goes down. Take for example, if you are investing for a secured retirement, there are various instruments where you can invest and avail the benefit under section 80C. If you take a home loan and when you pay the interest on that home loan, that interest is also covered under Section 80C. Or if a parent is funding the education of a child up to a certain limit, the education fees paid to the institution, be it a school or a college, that's eligible for deduction under Section 80C. And to that extent, you can reduce your tax burden. Life insurance policies are also covered. So if you pay a certain amount of premium, whatever amount of premium that you paid, that premium may be eligible for Section 80C benefit. While that is about life insurance, for health insurance, there is another section called Section 80D. The premium on health insurance policies that is eligible as deduction under Section 80D. So while what is getting taxed is important to understand, what are the various provisions, exempt income or deduction or set off, and some of the other provisions like Section 80C and 80D need to be understood. Last of the influencers, external influencers, is related to a government policy, and this policy actually transformed the structure of the society. At one point in time, there was a system where each employee on retirement would be eligible for certain pension, and this pension was determined based on at what salary one retired, what was the last drawn salary, and that last drawn salary was calculated for a certain period. At what salary one retired determined the pension that the employer would pay for the life of that individual after retirement. So that's called defined benefit system, where the benefit to the pensioner was defined linked to the last drawn salary. What it does is, it may put a heavy burden on the future finances of the employer. And who's the biggest employer in our country? Government of India. And when the pressure is put on Government of India, eventually it may result into poor financial management on part of the government. And a major reform was undertaken. And this reform was undertaken due to a particular report that came as a result of Project Oasis. This new reform was undertaken as part of Project Oasis. This Project Oasis was set up under the chairmanship of Sri S.A. Dave. What it meant was, the government shifted the whole structure from the defined benefit system that we just talked about to the defined contribution system. And what does it mean is, defined contribution means how much have you contributed towards your pension pool, which is nothing but how much have you invested. Instead of your last drawn salary, the pension would now be a function of your investments and what happens to the value of that investment over a period of time, and what are the interest rates when you start drawing your income from that pool of money which is accumulated. So the entire shift from defined benefit to defined contribution meant that now planning for retirement became the individual's responsibility or the family's responsibility. Let's look at some of the important provisions under Project Oasis. First of all, let's look at the type of retirees or type of people entering retirement. Central government employees who joined before 1st January 2004, as well as all the defense service employees, and that is irrespective of their joining date. in their case, we still continue with the old system, which is defined benefit system. And that means there is a guaranteed pension, there is also increase in the pension on account of inflation in the prices of goods and products that we consume, and there is a central provident fund. So for the defense forces, the defined benefit structure continues. For people who joined services before 1st January 2004, because the reforms were implemented in 2004, so those who had joined before that, they got that continuation of that benefit. But that also means people who joined after 1st January 2004, they, whether it is whatever job other than defense, if they joined after 1st January 2004, that means they were shifted to the defined contribution system, and the contribution has to be put in the National Pension Scheme or NPS. All the PSUs and all the private sector employees are now part of the defined contribution system. NPS also has a provision where private sector or self-employed or unorganized sector, all individual residents of India can also contribute to NPS privately. There is also the public provident fund where the interest rates are periodically set. So this is the overall structure of the pension system in India. And that brings us to the takeaways for the session. There are going to be many factors which are external, beyond the control of the household, but they may have an impact, however small or large, but there are these external factors. It's important to keep these factors in mind. Some may be predictable. For example, let's say the tax structure. For example, that the pension reforms have been implemented, but there could be something which is totally unexpected, and we just took a couple of examples, one being the latest pandemic, COVID-19. It just came out of the blue, but it had major impact on the financial situation of many Indian households. And that's something that this entire chapter aimed to bring out.